Hello and welcome back to Pay Down Debt Solutions. I'm Jen, and today we are going to go over credit card hacks that you can't afford to not know about. These are credit card hacks that will help you kick the traditional banking system that you are in currently to the curb and help you pay down your debts faster. So many of you come to us in credit card debt, and that is no different than the student scenario that we have today. These students came to us in some credit card debt and wanted to know how they could get out of it when they had pretty close to being maxed cards. So most of their cards are maxed. One of them in particular that we're working with today, and then the other card is not. So we're going to be going over some of these credit card hacks out there that are really important that you guys need to know about so that you know how to defeat the traditional banking system. So we are going to go over the 3 credit card hacks today that I think are some of the most important out there. Number 1 being income in and expenses out, learning how to run your credit cards like a bank account. Instead of using that bank account that you're currently using, you're going to be using your credit card from here on out, because that is how you are going to save in interest through average daily balance, which is what these credit cards are figured on. 2, the micropay strategy. So if you guys are at your limits and you want to keep your credit card limits from being cut, you have to deploy the credit or the micropay strategy. The micropay strategy is how you are able to continue having the limits that you're at and using that credit card, right? So right now you're looking at your credit cards and you're saying, I'm maxed, I can't use these credit cards anyway. So what are you talking about? What are you talking about, Jen? Well, I'm going to show you how you can still use these maxed credit cards. You can still use them, believe it or not. So they are not useless to you once you have them maxed out. You're going to learn how to use them and keep your credit card from being the limit from being cut at the same time. Okay, so that's what I'm going to teach you. You're also going to learn what to do if you can't get a balance transfer or a convenience check, but you do have the limits. Okay, so some of these banks out there, hence my student scenario here, they could not get convenience checks. Their bank turned them down. And so a lot of times what we're working towards is getting those convenience checks or getting a zero balance card. Well, in this case, they have some availability, but the bank said nope, and they can't use it. So I'm going to show you what we would do in a situation like that. So again, I come to you as an ex-banker, as an ex-branch manager. I am a business owner. And so that is what qualifies me to talk to you guys about these strategies here, because I didn't know what I didn't know. And as a bank manager and as a banker, I didn't know something called velocity banking, which is what we use with our pay down strategy. Velocity banking is a way of doing your banking, right? Non-traditionally doing banking, where you will defeat your interest and you will defeat your debt much faster than you are currently doing today. So let's get into these credit card hacks today. Let's talk about them. Let's figure out what to do with them. And then we're going to go over this student scenario right here and how they used some of these credit card hacks to help their situation. Okay, so income in and expenses out. So what in the world is income in and expenses out? Well, if you have a credit card, okay, so you have a credit card such as this, right? So let's draw a credit card here. So here's our credit card. All right, here's our credit card. Here is our bank account, okay? So this is your checking, okay? So we'll say C account. Okay, so currently, when you get paid, what happens? Well, you get a direct deposit or you get a check, right? And that check or direct deposit, and I got to find my purple marker because this is income, right? Purple's income. So your income comes into your check account, your banking account, right? So let's say it's, well, let's use our scenario here, $4,800. So $4,800 is going to go into this checking account, okay? And so out of that checking account, you're going to pay all of your bills, right? So here's a bill, here is a bill, here is a credit card, here is a loan, here is another loan, and here is your mortgage, right? Okay, so you're paying all of that out of your banking account, right? And at the end of the day, if you have anything left over, you're hoping to put that in a savings account, right? But such as life is, that is hardly something that we can do, right? So if you're in this student scenario that I have right here, and their cash flow is $150, where's that $150 going to go? Well, they're going to try to put it in their savings account. And if they can't put it in their savings account because life lifes them as it does, right? And they find that they have extra expenses, it's not going to go in the savings account, is it? It's going to go towards those extra expenses. And that's exactly why you guys come to us and have us help you with scenarios, right? And have us help you work your finances, because this happens to you all the time. And you're sitting in credit card debt, and we're going to learn how to get out of it much faster. So if you have this money, this checking, this direct deposit coming into your bank account, okay, so that money is going into your bank account and you're spending all of the money out of it to pay for all of your living expenses, right? So these are living expenses here. To give you an example, you've got gas that you're paying at $480. You've got groceries at $1,400. You've got utilities at $390. You have your insurance payment at $165, right? So all of that together ends up being $2,435 when you have $4,800 coming in. But then what happens? Well, you've got a mortgage payment, you've got a car payment, you've got another car payment. Those add up to $2,083. So then what? So that means you're left with about 150 bucks left, right? And that's what goes into savings, maybe if you can. Now, we are going to do something a little bit different though. When we use Velocity Banking, we are going to put our income instead of into our checking account here. Okay, our income doesn't go here. Our income now goes directly into this credit card. Okay, so your income's going into that credit card. Now, what if that credit card though is maxed out? Let's just say it's maxed out at, let's say it's maxed out at $5,200. Let's just say it's maxed out. Okay, so this one in this case is not, they have an $8,000 limit, but let's say it's maxed out at $5,200. All right, so you have $4,800 that's going to go into somewhere, right? It's coming into your checking account currently. So the majority of it would go into your checking account, right? But when we do Velocity Banking, we are actually going to put our income into our credit card or on our credit card, right? So we're making a payment to that credit card. And once we make a payment to that credit card, it's going to drop that balance, okay? So if I'm sitting here at $5,200, and let's say I can put, we're just going to say this for a second, hypothetically, let's say I can put $4,800 onto that credit card, then what happens? I'm left with what? A $200 balance, and that's it. I've pretty much paid off that credit card, haven't I? Now, you're going to be running your expenses, right? So remember, I said income in, right? So our income comes in, right? Our income comes in, but our expenses still have to come out, okay? So our expenses would be coming out. So into or onto this credit card would be my income, and out of this credit card would be all of these expenses, right? So all of them. So I'm paying for all of these expenses out. So what does that do for you, and how does that change your situation? How does it? Well, when you put your income into a debt tool or a debt weapon, a debt destroyer, as I like to call it, you are dropping the interest, number one. The first thing you're doing is dropping the interest from $5,200 down to $400, right? So that means that the interest you would pay is like nil, right? So it's almost nothing at that point, okay? So if you're able to do that, number one, you're dropping the interest so that you're lowering the card. And number two, any of those payments that you were making on that credit card, the $5,200, that payment then comes back to you as cash flow, and it works your card down faster, okay? And that's going to be my example today when I show you this student scenario. When we actually work it out, I'm going to actually show you exactly how that works. Now, that is one thing that makes this so incredible, okay? That is one of the number one credit card hacks, is learning how to put your income onto that credit card and running your expenses out to return your payments back to you as cash flow. And I know that sounds like Greek right now, but it'll make more sense when you see the example. Second credit card hack that I want to talk about are micropay strategies. So it's really important when you're sitting with a card like this, right? When you have a $5,200 credit card, okay, and it's maxed out, and if you were to go and make this entire income deposit onto that credit card, what's going to happen? Well, many of you know what's going to happen because it's already happened to quite a few of you, right? When you put a chunk payment down like that, your credit card company is going to lower the balance on that card. That's usually what they do. I'm sorry, not balance. They're going to lower the limit on that card. So that means they're stealing from you, right? They're stealing the available income or the available power, right, that you have to make expenses, okay, to be able to spend. So when they steal that money from you, you then lose your purchasing power, okay? And so that's what we want to keep them from doing, is stealing your purchasing power. So we deploy what we call the micropay strategy. So what on earth is the micropay strategy? Well, let me show you what the micropay strategy is. All right, so here is my handy dandy micropay strategy board, okay, as I almost lose it. So when you're deploying micropay strategy, okay, to keep the banks from cutting your limits, what you're going to be doing is, sorry about the hotspot there. What you're going to be doing is, let's say you have an available income to go and put onto your credit card. That available income is going to be, in this case, $1,620. We are going to divide that income up on our calendar, okay? Actually, on our statement period. We're going to do it by statement period. So we're going to divide that up, and we're basically going to, for all intents and purposes, we're going to say we're going to divide it by 15, okay? So every other day of the month, right? If there's 30 days in a month, then 15 is half of that. So we're going to then divide it by 15, and that means we're going to be putting $108 on our card every other day or so. So what does that mean for you? So what this means is, when your direct deposit comes into your checking account and you know you're going to be using this card per se as your debt destroyer, that means that the money from your direct deposit is going to go straight into your checking account, and you are going to every other day put $108 on your credit card. So you're going to make a payment every other day of about $108. Now, once you do that, and you see how your card is reacting, and if it doesn't react, then you can make them even less. So rather than 15, you can do maybe 10, okay? So you'd have to divide it out again. And instead of every other day, maybe you go every 2 days or every 3 days, okay? As long as the total amount ends up being $1,620, because that's what you want to put on your card, right? So what you're doing then is you are tricking, right, the algorithm that catches these big chunk payments, all right? So when you put a big chunk payment on, it's like a red flag that goes off to the bank. And the bank's like, oh, they made a big payment and we're nervous about them because maybe you've skipped a payment, or maybe you've paid a partial payment on your credit card because you couldn't pay the whole thing, right? So maybe you've gotten into situations like that. Well, the bank gets nervous about you per se, okay? So when they get nervous about you, that means that they're going to be watching you more closely. And so these algorithms pick up big chunk deposits. So you have to be careful, and you have to deploy our micropay strategy, okay? So you want to make sure that you do that so that you have purchasing power available to you, right? Because if you're going to be purchasing these things anyway, right? Now remember, you've got that card. It's maxed out. You think you can't use it, right? Well, you're wrong. Because the minute you put your income onto that card, what happens? You free up balances, don't you? You free up availability. And so that means that if you put $480 on your or in your gas tank every month, okay, between two cars, let's say, and you put $480 in your gas tank every month. Sorry, did I say week? I meant month. Well, you're going to be spending that out of your bank account anyway, right? So why wouldn't you just put it on your credit card instead, right? Why wouldn't you do that? Now, if you have groceries and you're spending $1,400 a month on groceries, and that's coming out of your bank account for the most part, why wouldn't you then instead make a payment to the card of that $1,400 for groceries, right? Put it on your card and then expend out of that credit card for your groceries. Same thing with utilities, same thing with your insurance, okay? So all of these bills that you can put on your credit card, you are going to be charging off of your credit card. So you're going to put the income into it. You're going to charge those expenses out. So what are you doing? When you do that, you're taking, again, this maxed out card, putting your income into it, dropping your balance immediately. You're stopping the interest on that card, right? You're stopping the interest, all right? And you then can use the card again. And the payment that you would have paid right here, which is, if this is the card, if it's a $160 payment, that payment then all goes in to work down your card for you. Another thing that you guys have to remember too, if you have a card sitting at $5,200 and you're able to put your entire income onto that card every single month, and you're basically paying it off, right? So when you pay off that card or pay off what you've charged on that statement period, okay, on a card like this, you now don't owe any interest. Have you ever looked at your credit card, and those of you that pay off your card pretty much every month, okay? Or I should say this, you pay off that statement period amount every month. When you do that, there's no interest charged. So you're stopping the interest for yourself if you have the ability to do it this way. Now, some of you don't, but those of you that do, you don't pay interest anyway when you do it that way, right? So think about that. Okay, so I've talked about micropay. I've talked about income in and expenses out. So now let's talk about what you would do if you cannot get a balance transfer or a convenience check, such as these students couldn't. Their bank said, nope, we're just not going to do that for you, okay? So then what would you do in a scenario like that, okay? So let me go over this. I'm going to clear some of this board. I'm going to clear some of this over here too, so that we can write this out for you and make it make some good sense, so I can show you another way that you can defeat the banks, another hack for you. So let's talk about this situation for my student here. Well, here's their scenario. They have an income of $4,800. They have total expenses of $4,650. They then have a cash flow of $150, just like I talked about earlier. We have a Chase card here, and it is at $5,200. So that Chase card is $5,200. The payment on that card is $160. It is at a 25% interest rate. This card here it would take them 4.7 years to bank this traditionally through their checking account. So it would take them 4.7 years, and they would spend, to do that, $3,556, okay, out of their pocket. So for $5,200 borrowed, they are going to spend $3,556 in interest, right? Ludicrous. Again, like I say all the time, that is ludicrous. So we are going to stop that. So here they have a BOA card, okay? This card is maxed, and I should say that this Chase card, it does have an $8,000 limit on it, okay? And that's where they wanted to maybe do a balance transfer. Well, Chase said, no, we're not going to do that for you, which is, it's their prerogative, right? They can do that. So they have made this distinction that they've said, nope, we're not going to do that. So Bank of America is sitting at $2,210. It is at a $72 payment. The interest on that card is 27%. It is at a 4.5-year payback, okay? So these are both interest in 1%. So that means that it would take them for $2,210 borrowed, $1,595 if they continue to make these payments such as they are, which means that the total dollar amount that they're going to owe by the time this is all said and done is $5,151 they're going to be spending on interest. When they have borrowed, $74.10, okay? When between these two cards, it's $74.10. So what options do they have? Well, could we run a split card strategy? Well, maybe we might be able to run a split card strategy, right? So we could do that. That's one option when you can't do a balance transfer. So we could do that, right? We could. But let's back up for a second. Let's talk about the available income, because remember, when you're working with credit cards, there is income that is available to you to use and income that you can't use, right? So the income that you can't use, all right, would be anything like a loan or a credit card, right? So because you can't charge other loans on a credit card, and you can't charge your mortgage on a credit card, and you can't charge other credit cards on a credit card, that means that those payments have to be held back into your checking account. So remember earlier when I had your credit card and your checking account, there are some dollar amounts that you have to leave in your checking account so that you can pay those out of your checking account. Well, why then, Jen, would I even bother with any of this, right? Why would I bother with it? Why wouldn't I just pay it out of my checking account then? Well, you don't want to do that because we are working down your debts faster when we put our income into that credit card, the available income, and we work out all the chargeable expenses out. Now, as you can tell, I have changed it from available income to chargeable expenses, right? So that means some of that you will have to hold back and pay out of your checking account. But when you do it this way and put the majority of your income onto those credit cards, you're going to see how fast that works for you. Okay, So I have to then look at this and say, okay, what income is available for me to use? All right. So we know that in their situation, they have $4,800 that is available income to them. Okay. But we have to subtract off the mortgage and the two car payments, which totals 2,083, right? 2,083, because they aren't usable. I can't charge those on a credit card. So I have to hold that out of my income and leave it in my checking account. All right. So that means I have available to me to use 2,717. But wait a minute, Jen, wait a minute. There's two other bills here, right? There's the Chase payment and there is the payment from Bank of America, which clearly is not put into the available income. And it isn't put into the income because when we run, let's say a split card strategy, right? If we do that, that means that we're getting back those expenses. I'm sorry, we're getting back those payments as cash flow back to us, right? So we can use that back into our expenses. I'm sorry, we can use that back into our income, and we can split up our income then between those two cards with it. Now, the chargeable expenses are $46.50, right? So here we have $46.50. And that means, again, the chargeable expenses, right? So the non-chargeables have to be taken out, right? So mortgage, car, and car are non-chargeable, okay? So that 2083 is taken out. Now, this 72 and this 160 is not chargeable. So we have to then take those out, right? So what we're left with are chargeable expenses of $2,335. Those are chargeable to me. So that means that I have available income of $2,717 and chargeable expenses of $2,335. Now, if I do this right, there is enough differential between these two where I can split these and use them and get back that money, right? That should work out. So what do we do? So, okay, so it looks like we're running a split card strategy, but are we? Are we? Here's the thing. We know we can use 2717, right? Well, how much is our Bank of America card? Oh, wait a minute. Whoa, 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 whoa. It is 2210, right? But I have 2717 I can use. Okay. So if we do something different, we can't pull money over onto our Chase card, right? We can't do that because Chase won't allow us to. They're not going to give us convenience checks and they're not going to then absorb that payment for us, right? So here's what we can do. We can take our available income of $27.17 and we can pay off this Bank of America card. How can we do that? Because we still have expenses, right? And you're right, we do. But if I pay this card off, right, the 2210, okay, so I put in income of 2210 onto this card, make it 0, and I put the remainder of my income, which is 507, right? So if we take the 2210 and the 507 and we add them up, they're going to equal this, the 2717. So I got rid of this card, so I no longer have to worry about my Bank of America card, right? That's gone. So this is gone. And so I'm putting 507 onto this card. And will that work? Yes, it will work. Why is that? Because we know that my payment is $160. So I'm overpaying that card, right? My income is going in and I'm going to run all of my expenses out. So here's what happens. So when I do this, I'm dropping my balance to $46.93. But we know that we still have expenses that we have to run, right? We have expenses that are going to come out, and those expenses total the $2,335. So what do? Well, I'm going to use that card, of course, and I'm going to buy all of my gas on my Chase card. I'm going to buy all of my groceries on my Chase card, right? I'm going to buy all of my utilities through my Chase card. And my insurance that I owe is going to be set through my Chase card now. So that means I have to add back in the $2,335. But that's okay, right? Because my limit on this card is $8,000. And if my limit is $8,000, okay, and I know that when I calculate my insurance, or not my insurance, but I'm sorry, my interest on this amount right here, it's going to be 103. Well, how do I know what that month's interest was on that card? Well, this is what you do. we need to calculate the interest. And we know that we started with $5,200. So we take $5,200 and I'm going to add the $4,693. And I'm going to write this out for you guys so you can really see it. Okay. So I've got 5,200. So 5,200, I'm going to add my 4693, right? All right. So what does that equal? 5,200 plus 4693 equals 9893. Okay. So I'm going to take an average though, right? Because we know this is my high balance for the month. We know this is my low balance for just this month. And I have to figure out what my interest is going to be so I know if this will work. Because if this interest is super high and it goes over my 8,000, there's no way this is going to work, okay? Clearly you can see it's going to work here, but this is how I want you guys to look at things. So when you're calculating your plan, you're going to know if it's going to work for you, okay? So you're going to take the 5,200, you're going to add in your low balance, right? So we're going to get 9893. We then divide that by 2 to give us the average, okay, which is the 4946, okay? So we're going to divide this by 2, okay? So that equals 4946, right? Now, I'm going to take my 4946 and I'm going to multiply it by my interest, okay? So my interest is 25%. Well, if you have a percent, you can do it on a percent. I'm going to do it by 0.25, right? Which is going to equal, so I'm going to multiply it by 0.25, which equals 1236. So 1,236 is my interest for the entire year, okay? So don't make that mistake. I don't want you guys looking at it saying, oh my gosh, my interest is, $1,236. There's no way this is going to work. Well, it is going to work because you're going to then divide this by 12, okay? And that is going to equal the 103 that I have on the board. Whoops, not 130, 103. Okay, so now your interest you've calculated at 103. Now, every month you do this though, if you're doing your plan correctly, your interest is going to drop, okay, every single month. So this should go down. Now, could there be a month when you go in the wrong direction? Because we know that the 150 that you might have in cash flow gets eaten up somewhere by some charge. And you have to use your credit card to make a purchase, tires on your car, a new washing machine, I don't know, whatever happens in life, right? The things that happen. Big vet bill, like in my case, might be a big vet bill, right? So you have some expense, right, that you have to do. So it could be that one month goes in the wrong direction. That's okay. Because when you run strategies with Velocity Banking and you do it this way, you can absorb those costs through those cards. Most of the things that you buy in life at this point, you can purchase on a credit card. So it should work out okay for you, all right? So now we start with, okay, so we know that our expenses for the month are going to come out. We know what our interest is. It's 103. So our starting point now is 7,131. So 7,131. Now, this is going to be the jumping off point for our strategy, right? Because we didn't actually do a split card strategy. We had intended to, but when we looked at things and realized, well, shoot, I can put all of my income onto that card, wipe it out, right? Wipe out that Bank of America card, and then I can carry through with this card here, which is exactly what we've done. So when you realize you can do that, you can either change all of this if you want, right? You can change it for the new structure, the new expenses, or you can let it run because it's not going to change it by all that much, right? So we're going to just carry it forward. And so now we start with 7,131 and our income then comes in. So what does that look like? Well, we know our income is going to be 2717. So we minus 2717, okay? So then what does that drop us to? It drops us to, and here, I have a cheat sheet here. It drops us to 4414, okay? But then our expenses have to come out again, right? So our expenses then are going to come out. So we're going to put those in. So we're going to add those in. So 2335, right? So 2335. And then we still have to add in our interest, okay? So our interest then has to be added. And I believe our interest is 114. So 114, okay? So that means that month number 2, where are we at? Well, that means that we are at, let's see, it is 103. Oh, no, not 114. Sorry, it's 120. The interest was wrong here. It's like something looks wrong. That's what it is. All right, let me fix the interest. So it is 120, right? So 120. Okay, so that means I'm starting off at 6869. 6869. All right, now, is 6869 more or less than 7131, right? This is our checks. This is what I'm talking about if you have a bad month and it goes in the opposite direction. So long as you're not doing this month after month after month, you should be okay. So we're at 6869 and it is lower than the 7131. We are going in the right direction. So this is our new plan, right? So when you have a situation such as this, where you have a bank that isn't going to allow you to move balances over, there are different things that you can do. And in this case, that worked out. Now, it might be that you just have to buy yourself a little bit of time to do an entire balance transfer, if that's the case. Most of the time, though, your card companies, since you have enough availability and you haven't maxed that card out, they're going to go ahead and give you the opportunity to move your balances over, right? So that's what you're hoping for, and that's what you're going to do. If not, then you're going to do a zero balance transfer and you're going to take care of it that way. So wanted to remind you guys of the workshop really quickly. Our workshop is the 26th. We have 2 openings left on that. If you want to get in, you're going to be able to work your own worksheets. You're going to build your own strategy, and we are going to show you how to do that. So we are going to be looking over your shoulder, helping you in that workshop. So that is, I'm sorry, not the 26th. I keep saying that. It's the 27th. So that is Sunday, July 27th. And if you want to get involved in that, just shoot us an email. It's info@paydowndebtsolutions.com. So it's right down here for you. Let us know if you want to get in on that. So now that we know how to run this, what is the difference, right? So what you were going to pay traditionally $5,151, right? So if you run this strategy, what is the time frame that it's going to take? So how long is it going to take and what are you going to spend? Remember, getting back these payments is key and pivotal with this strategy, right? When you're running your income in and your expenses out. It will save you so much time and so much money, you won't even be able to believe it. And that is how Dan and I got ourselves out of all of this debt that we were in. And as business owners, you find yourself in a lot of debt sometimes. Well, this saved our rear ends, right? And I'm going to show you. So now, how long did this take? Well, this in particular took us a total of 15 months. Okay, so 15 months to run this strategy, and it cost us $1,167 over a 15-month period of time. So, would you rather spend $1,167 or do you want to go ahead and spend $5,151 by running things through your checking account as you're currently doing, when instead you can be spending all of these expenses on that credit card, probably earning yourself a lot of points in the process, right? So there are great points cards out there that you can be building points on and you can get cash back for things you're going to buy anyway. Why wouldn't you do that, right? I hope you guys have learned something today. I hope you've realized that there are many different ways to skin a cat, right? And that's what's so beautiful about Velocity Banking. There are multiple ways that you can do this. Some of the biggest problems that you guys find yourself in are definitely the credit card debts, and you may not be able to get a line of credit. And so you're sitting there having to figure out what you can do with the credit cards you currently have. Well, this is what we work with every day, you guys, learning how to use those credit cards to get back your payments so that you can do this, right, in 15 months versus, the 5 years or almost 5 years, the 4.5 years that it would take on this side. So I hope you've learned something today. I hope that you guys continue to watch and pay attention. You guys, I want to ask you a favor. If those of you out there that haven't subscribed, please go ahead and like and subscribe. We are trying to get the word out. And we are also going to do another giveaway of a one-on-one coaching plan for new subscribers. So we want to get you guys learning, right? We want to get you guys out there who haven't learned about Velocity Banking. We want you to learn about it. And the only way to do that is by you guys subscribing and liking us, because that gets us out there, right? Again, it's all about algorithms. So for anyone that would like to get in on this, I would like you to just email me, and in the subject line, just put giveaway and coaching one-on-one giveaway. Let me know that you've subscribed, and I will enter you in for a free one-on-one coaching plan. Have a great day, you guys, and I will see you in the next video.